In this video, let's take a look at the federal income tax forms that we need to prepare for a taxpayer that has a sole proprietorship. That's a business that's not a corporation and with only one owner. So what we're looking at is our Form 1040 that we had learned from last semester to prepare. Always make sure that you're using the correct year version. In that prior year tax course, we learned the things like the filing status, standard deduction, dependency, common types of income like listed here on the 1040 form down from line 1 through line 6. But here in our chapter 3, where we're learning business income, we don't see any business income line item here. So that has to go with these other income that is first reported on a schedule number 1. So let's take a look at a schedule 1 that is going to be attached to the 1040 form. Again, always make sure you have the correct year version. This schedule 1 has two parts. Here in part 1, we're looking at additional income types of revenue. And in part 2 are deductions called adjustments. The specific line we want to work with is this line 3, business income, or even a possible loss we get to subtract out. And to calculate out that business income or loss, we need to do that on a schedule letter C. So let's look at schedule C. That eventually is going to be attached to our 1040 form. And here's our correct tax year. On the form, you would enter the taxpayer owner's name here and their social security number, the type of business they're operating, and you would look up in the instructions to the Schedule C a code number that matches that business type. If the taxpayer is using their name as the business name, you don't need to possibly fill in this line C. But if you have a DBA, doing business as name, you would have to enter it here. The business address in line E possibly could be the same address where the taxpayer lives. Accounting method is a topic we'll see in our chapter 6. Here's a question the form is asking: whether our taxpayer owner materially participates in the business. The reason for asking this question is that if there is a loss suffered by this business, the loss may not necessarily be deductible. We're going to learn probably in a future chapter there's limitations to deducting losses called passive loss rules and at-risk rules. So that's what this question is addressing. These two questions here, I and J, ask whether our company, our business, is going to file Form 1099. Now, most taxpayers are familiar with receiving Form 1099 because they've earned income from some source. But now, our business is the source of money being paid out to other people, to other businesses. So, the common form that may be issued is Form 1099 miscellaneous. If you're paying an independent contractor, if you're paying another business for services and that other business is not a corporation. Now, beginning for the year 2020, there's a comparable form that needs to be filled out called 1099 NEC for non-employee compensation. So here's a couple examples. Here's the 1099 for 2019. And the common one we fill in is this: when we pay contractors, when we pay non-employees for their services. Instead of issuing out a W-2 to employees, this 1099 form will go to those non-employees. And then beginning in the year 2020, we would be using this 1099 NEC for those non-employee amounts, non-employee compensation amounts. Back here on Schedule C, those amounts are typically deducted, let's say here, as commission or fees we pay out to other businesses or to contract labor. Okay, contract labor, and not here what we pay to our employees as wages or salaries. Okay, so if you are paying that type of payments, you should be saying yes and then filing those 1099 forms. Here in part one, we're going to be calculating out our company's gross income, starting off with the total amount of receipts or sales we made during the year and minusing out any returns, refunds, and allowances we make to get our company's net sales or net fees. Then we're going to subtract out for merchandising companies possibly a large deduction called cost of goods sold that's calculated here on the back side of the Schedule C. And if you've taken prior financial accounting classes, you've learned this cost of goods sold calculation where we start off with the amount of merchandise that we didn't sell from the previous year. And now we're going to start off as a beginning inventory, to which we add what we buy during the year to resell, called purchases. The thing is, we got to reduce it by anything the owner takes out for personal use. If you don't make this adjustment, you're artificially increasing, possibly illegally, the cost of goods sold deduction. Now, if you're a manufacturer, there's labor involved in your assembly and materials that you have to add in, and possibly any possible overhead costs that we need to allocate to the merchandise. And if you add up all of these lines above, what you get is the total merchandise that's available for sale. And if you sell everything, this is what you get to deduct. But if I look at your store shelves and warehouse at the end of the year, there's probably stuff there that's unsold. So we need to back that out. That's your ending inventory. To get the amount that you get to deduct for the year, here called cost of goods sold. And in that previous financial accounting class, you remember the terms FIFO and LIFO and average and lower of cost or market. So all of those rules may still apply. You have to calculate out your cost of goods sold deduction that again we subtract over here to get your company's, your business's gross profit. And if you have some other miscellaneous type of business incomes for your business, you add it in here in line 6 to get your gross income, for your business for the year. Now we get to subtract out here in part 2 all of the other expenses for your business. And as you can see, these two columns, they're pretty much listed in alphabetical order. One of the main subjects in this chapter 3 we're currently working on is some of the limitation to these certain one of these deductions, like this transportation costs. We'll have a whole chapter later on in calculating out a company's depreciation. We see in our current chapter 3, there may be restrictions on what we get to deduct for travel and for business meals. What you don't see here listed is anything for entertainment. From 2018 and now scheduled to 2025, you cannot deduct any costs for business entertainment, but you still can deduct, if you can separate it out, the cost of business meals. At least 50% is still deductible. If you cannot see here in this listing in part 2 any specific expense that matches yours, you can use this line 27A, where we need to use the backside again of the Schedule C and write in the description of what's being deducted and then the applicable costs. Yeah, we're listing them as specific itemized amounts here, okay, and dollar amount. And take a subtotal and then rewrite that back on the front side of the Schedule C in line 27A. We then take a grand total of adding up all of these amounts to get our total expenses for the year, business expenses, and we subtract that from our gross income to get a tentative profit or loss. The reason why it's tentative because we have possibly one more deduction that we learned here in chapter 3 called a home office expense or home office deduction. and we learned how to prepare this form 8829. Or an option is to do a safe harbor or simplified method where we write in the business square footage of our home office and multiply it by $5 per square foot and getting a maximum deduction here. You can't go over, I believe, $1,500 for the year. So the tentative profit minus the deduction equals now the true net profit or loss for the year. And we write this net profit or loss back on schedule number 1, back here on line 3. And we add it up with all the other miscellaneous income here in line 9. Then we recopy it back to the 1040 form here in line 7A. And we grab all this other income we are familiar with from our prior tax class to get a total income. Then we subtract out adjustments. We're going to see one adjustment here. Well, let's go back to our Schedule C. So we just recorded this income on the Schedule 1. But if you read the fine print here, it says also you got to put it on a form called a Schedule SE. So if you remember, if you're an employee, the employer is going to withhold not just income taxes, but Social Security, Medicare taxes. Well, in the case of a self-employed taxpayer, there is no employer. You're the employer, right? So you gotta pay your own Social Security and Medicare taxes, and they call that tax the SE, or self-employment tax, that we calculate here on this Schedule SE, and we attach it to the 1040 form. We'll get more into this calculation possibly in Chapter 6. We'll see maybe in the backside there's an alternate calculation here. But basically we would rewrite that profit we have back on from Schedule C over here. And because this self-employment tax is such a big hit, the government gives you a slight discount to the tax by reducing it to this percentage here. And if your answer is less than $400, you don't owe any of this self-employment tax. But if it's $400 or more, you're going to multiply that amount by this high 15.3% self-employment tax rate. Now, if you were an employee, the employer would withhold half of this 15.3 and match it with the same amount to total up to 15.3. But because you're self-employed and you don't have an employer, you pay the whole thing. Okay, so that's the self-employment tax here in line 5. And again, because it's such a big hit on our taxpayer, sole proprietor, the government is going to give them a break by allowing a deduction of 50% of that amount. 50%. Okay, so whatever amount you see here, we're going to first rewrite it back on schedule number 1, not here as income, but as an adjustment deduction. Adjustment deduction. And that goes in this line 14. Line 14 here. That we add up with the other adjustments to get a total of adjustments that is now deducted back on the 1040 form. You can see we're just bouncing around from form to form. Here, all the adjustment deductions, the adjustments that we subtract to get our AGI. You subtract out the standard or itemized deductions we learned last semester to get our taxable income. Then we look up that taxable income in the tax tables to get our total tax liability for the year. But how about that self-employment tax? Well, it's on a schedule number 2. So if you look at that self-employment tax, it says to take this self-employment tax amount and write it in schedule 2. So here's a schedule number 2. Again, another attachment to the 1040 form. And the self-employment tax here in line number 4. Then we combine with all some other miscellaneous taxes and then rewrite that total back on the 1040 form right here. Yeah. So income tax, self-employment tax, and then the looks like the total of all the taxes down here. Okay, before subtracting out any taxes we paid and any credits again that you've learned in the prior semester. Let me stop here. So we'll be working with tax returns, 1040 forms, including any Schedule C and Schedule SC in this chapter 3. Okay, so if you have questions, make sure you email me. I'll talk to you later.